Hello everybody, and welcome back to the Costing and Pricing Learning Program. My name is David Gilchrist, and this is webinar number 15. In this webinar, we're going to have a look at the NDIS pricing model. We're going to have a look at it from two perspectives. One, to consider some of the components that are in that perspective, and the second, to be able to talk about how we might take this information into account when we consider our sustainability as a disability service organisation. First, just to make sure everyone's aware, this is copyright material. That doesn't prevent you from using the material for whatever purposes that you like, but you can't disaggregate it. That is, you can't use items or elements separately, and you can't remove the logos or other features. However, please use it for whatever capacity building program you would find useful. Secondly, just to confirm our navigation, this webinar, of course, is webinar 15. The last webinar we looked at costing practice and calculating staff costs. I think webinars 14 and 15 are interesting to look at together on the basis that in webinar 14 we built up the cost, if you like, from the ground floor by looking at an individual and the cost elements relevant to that person and deploying them for service delivery. In webinar 15, so this webinar, we're looking at the NDIS pricing model, and if you like, working backwards to an extent to understand how we can reconcile our costs against those costs that help to derive the price that is offered by the NDIS. The next webinar, webinar 16, will look at costing tools, so the same sort of area, but looking at the organisational perspective. Let's have a look at this particular topic now. In this webinar, we're looking to, I guess, communicate with finance personnel or other personnel within a disability service organisation that are interested in the components of the NDIS pricing model, how their organisation might consider its costing and pricing components in that context, and I guess to an extent try to reconcile the difference between what you consider to be the cost of service delivery in a comprehensive sense and what the cost is, or rather what the price is that's offered by the NDIS. Of course, policy makers and sector leaders might also be interested in this webinar because it provides an overview of the NDIS model and the components of cost that are included in that model. Let's just have a look at some issues. As always, we're concerned in the Costing and Pricing Learning Program to do two things. To one, arrive at a complete and, if you like, intellectually, for want of a better term, based understanding of the comprehensive cost of our service delivery. On the other hand, we want to use that comprehensive cost to understand what our price is, and at the end of the day to be able to compare our price, or our calculated desired price, which we have called in the Costing and Pricing Learning Program the targeted price, with that price that's offered by the NDIS, or indeed offered by any other funder of your services. That price that's offered provides a difference between, or rather allows you to understand the difference between what is being provided to you in terms of funding and what price would be the best possible price for your organisation. You need to understand what you should include in the calculation of your organisation's reasonable price, as well as understand what is in the NDIS reasonable cost model price. Other issues to consider, though, include how you might approach things like volunteer time, how you might approach the costing of donated assets, and other elements that are fairly important to understanding what the total consumption of resources is in delivering services. Additionally, if you have volunteer time or donated assets included in the contribution that you make towards service delivery, and you don't take those costs into consideration, then you might find that you're at risk because you're reporting a lower cost than service delivery warrants, but also taking risk because ultimately those volunteer times, that volunteer resource or the donated resource might not be available, and at some future point you might need to consider that as part of the cost of service delivery. The other thing that you might not be aware of is that the NDIA has on its website, so ndis.gov.au, a report called the Joint Pricing Project Final Report, and that will also give you some good insight into how the NDIA arrives at prices, and particularly some of the percentages that are applied for on-costs and overheads and so on. I'll talk to that as we go through today's presentation, but it's worth having a look at that, and I have the website on a slide in a few minutes' time. But let's have a look at the basics of the NDIS reasonable cost model price. The NDIS reasonable cost model price describes the components of cost that are taken into consideration in arriving at a price that's offered for services. It's a result of the joint pricing project final report, or rather components of that are, and it also confirms, and I think this is important, that a risk-based margin should be included. That is, organisations should not only be costing out the comprehensive cost of their services and recovering those costs, but you also need to, it is recognised that you also need to make a profit on your services. Let's have a look at a schematic that provides an overview of the reasonable cost model price. We'll have a more specific discussion in a few moments on each of the components, but as you can see, essentially there are three sets of costs that are incorporated in this price, as well as a risk-adjusted margin to arrive at the total price. The direct salary costs are taken into consideration, the program management and administration costs, so those costs that are associated with keeping that program operating and making sure that the program has all of its administrative requirements taken into consideration, and then the broader management overhead. Let's have a look at some of those components. Firstly, the direct salary cost. The salaries in the NDIS reasonable cost model are specified at a particular pay point. Now again, go back to the report and look at the pay point. I don't want to talk about specific numbers in this webinar for two reasons. One, because they are changeable, and secondly, because this webinar is really designed to give you a little bit of a taste of this model so that you can go back and look at the report and the model in your own time. But it's important to note that the salaries are pegged at a particular pay point in a particular award. And of course that might be relevant to your organisation, it might not be relevant to your organisation, but more importantly, we also need to look at what the pay point, how the pay point reconciles to your staff, and perhaps more importantly, how it will reconcile to your staff award conditions and arrangements in time to come. The second thing that is taken into consideration with direct salary cost is staff utilisation, or what we might call productive time. Staff utilisation or productive time relates to the client-facing time that a staff member has available in a normal working day. This client-facing time is the productive time because that's the time within which the staff member has to recover their costs and all of the other costs associated with operating your organisation. So they need to be taken into consideration whether or not it is practical for your staff to have the productivity levels that the NDIA takes into consideration. Finally, the depreciated salary related costs are also very important. They're the components like superannuation and annual leave, and they're termed to be depreciated salary costs because those costs are incurred today at today's price, if you like. However, in future they will be paid, and very probably paid at some future level of cost as a result of increases in pay and perhaps even increases in CPI amounts or even superannuation amounts. So you need to take into consideration not just the depreciated salary costs as they are when you incur them, but the likelihood of paying those out relatively soon so that the costs aren't inflated in the future and that they're fully recovered. The second element that I talked about previously was this of staff utilisation. When you think about staff utilisation in the context of the reasonable cost model, you need to think about how many units of measurement a staff member can provide in a normal working day. Remembering that a unit of measurement is an iteration of a service element. So often it is an hour, it might be a visit, it might be, and I know we don't like to use the term, but it might be a bed day or some other iteration of service. But a UOM is an iteration of service that allows you to cost to that UOM. For instance, if it takes 2 hours to deliver one UOM, and a staff member works 8 hours in a day, then the maximum number of UOMs, units of measurement, they can deliver is of course 4. What we're interested in here though is what percentage of a staff member's time is taken up in providing services, i.e. the productive time, as compared to what percentage is taken up in administrative, travel or other elements in terms of being able to make sure that staff is able to deliver a service to a client. Interestingly, the joint pricing project came up with a number of 85%. That is 85% of the time a staff member should be in front of a client, if you like, undertaking productive work. The other 15% of the time is taken up with other things such as administration, training and even annual leave. Now this 85% is a very subjective number, of course, and it depends from organisation to organisation just how productive you can be. But obviously, from a sustainability perspective, organisations need to compare their level of productivity with that posited by the NDIA so that you can be able to reconcile the relative cost, the relative productivity between your organisation and the expectations under the NDIS. Another component which I talked about before, of course, is the depreciated salary related costs, so things like annual leave, long service leave and so on. Remembering that the depreciated salary costs relate to the cost incurred at the point of paying a person or at the point of deploying a person, and things like annual leave and long service leave particularly, as you know, can be paid out at a inflated cost at some future point in time, particularly if it is leave is not managed very well and people don't take their leave for an extended period. It can mean that that leave is paid out at a much more inflated rate and that your costs aren't recovered. So there's two aspects to this. One is making sure, of course, that you manage your leave such that the costs are recovered, but secondly, making sure that you're comfortable that the leave expectations or the leave calculations that you make when you derive your comprehensive cost of service delivery is commensurate with those assumptions made by the NDIS. Loadings, of course, are also added here, and you would have recalled that in terms of the schematic for the scheme, that the loadings are an additional box that are loaded onto the costs that are already provided for an organisation providing services, say, in a metropolitan area in Australia. Those loadings relate to complexity. So there are loadings associated with clients that might have more complex needs, may have more significant and more difficult needs to manage or deal with, and also in relation to location, particularly rural, regional and importantly remote locations attract a loading as well. Again, from a sustainability perspective, you need to be looking at those loadings in the context of the comprehensive cost of service delivery, so that if, for instance, you're providing services in a rural, regional or even a remote area where it may be that your staff need to have a four-wheel drive rather than having a Hyundai Getz, then there are costs associated with holding that vehicle, using it, maintaining it and so on, that are over and above the normal costs of service delivery in a metropolitan location. The next group of costs, the program management and administration costs, relate to, if you like, the direct, variable and fixed program costs or overheads associated with the program itself. The kinds of things that are taken into consideration in this group of costs include span of control, the direct, variable and fixed program costs, and also, again, loadings for complexity and location. Probably the most important aspect of this program management and administration cost group is that of span of control. That is, how many staff can a supervisor oversee such that you maintain quality of service delivery, you have adequate supervision, and you maintain your governance processes around things like clinical governance to make sure that OC health and safety and clinical risks are maintained or dealt with. The span of control undertaken in the reasonable cost model is 15:1. That is, that one supervisor is able to supervise 15 people in terms of the delivery of services. Again, you need to reconcile your organisation to this to be able to identify potential problems associated with that level of supervision and whether or not particularly your organisation can manage within that, span of control that has been published. And clearly, direct, variable and fixed program costs also need to be taken into consideration, and when you read the joint pricing final report, you'll notice that there are percentages set aside for those particular elements. You need to compare your comprehensive costs with those particular elements that are provided for in the report to get a sense of whether or not you're in the ballpark for those particular elements. Loadings for complexity and location are similar to those for direct salaries and wages costs, and take into account the fact that there are increased costs associated with the complexity of service provision. There might be increased costs in terms of supervision, for instance, or clinical governance arrangements, and also in relation to location itself. Management overhead is the third group of costs that need to be taken into consideration, and these are costs that are associated with running your corporation, and indeed all other infrastructure costs that are not taken into consideration as direct program costs or direct staff costs. They might be things like the media or PR costs, they might be things like the costs of buildings for your head office and so on, but they probably also include things like your CEO costs, perhaps your payroll costs, your accounting costs, and other costs that are undertaken at that corporate level. Again, there are percentages provided for in the reasonable cost model and the joint pricing final report that give you a sense of what's taken into consideration from an NDIS perspective, and again you need to reconcile what the NDIS is suggesting as an appropriate percentage to apply to these costs as compared to what it costs you to deliver your services. Finally, there's the risk-adjusted margin. The risk-adjusted margin is the margin that provides or is intended to provide the profit on operations for your organisation. We need to go back to some of the foundational webinars to really look at pricing, particularly webinar 5, but certainly webinars 2 and 3 are also useful to consider on that basis as well. But we need to make a profit in our operations for two reasons. One, to ensure short and medium-term sustainability from a solvency and a financial perspective, but in the long term we need to ensure that we make a profit in order to be able to replace assets and ensure the organisation has the capacity to continue to deliver services into the future. The joint pricing project suggested a 5% risk-adjusted margin was appropriate. And again, you need to come back and reconcile that risk-adjusted margin with your expectations and what you think you need to remain sustainable in the short, medium and longer term, but also to think in terms of how you might reconcile that total price offered by the NDIS with your total comprehensive cost of service delivery, including your required risk-adjusted margin, to make sure that you're in the ballpark of those costs. Of course, there are a number of considerations here that we need to take into account from a sustainability perspective. The first one is, of course, span of control and whether or not the supervisory arrangements in your organisation are able to meet the challenges of the supervision arrangements that are made within the NDIS price. The average award level of staff also needs to be considered, and your staff mix might need to be reviewed in order to make sure that you are maintaining as close as possible the average award level that is taken into consideration in the pricing arrangements under the NDIS. You need to think about the productive time, the productivity of your staff, and the amount of or proportion of time they have to be client-facing. As indicated, again, with all of these elements, you need to reconcile what your experience is and what you can manage, what you believe delivers a safe, reliable and clinically appropriate service within your organisation and with your clients to reconcile to the NDIS arrangements and the assumptions made to arrive at the price. Again, comprehensive costs, volunteer time, donated inputs all need to also be taken into consideration. Go back and have a look at the Joint Pricing Project Final Report. It is available at the NDIS website. You need to search for the Joint Pricing Project Final Report in order to be able to download it. But it is worthwhile reading, and in that report you will see the percentages that were assumed at that time, and we're going back a number of years now, so that these percentages are not necessarily relevant to today, but they do give you a good assessment of the components that are taken up in developing the NDIS price and allow you to consider your comprehensive costs and expected or needed price against that, in order to perhaps highlight areas where you might need to be more efficient, highlight areas where you might need to report back to the NDIS or indeed National Disability Services, NDS, to be able to inform them of areas where the pricing is not sufficient to be able to sustain your organisation, or you might need to make changes in terms of how you are moving forward with your operations. Some further thoughts just to, I guess, maintain the philosophy, for want of a better term, of the Costing and Pricing Learning Program. Costing is an iterative process, so you need to recost regularly, and I'm sure regular visitors to these webinar series and training series would remember that we need to continually reiterate our costing process. But we also need to run the rule over the NDIS pricing structure and compare our costs and prices to that structure to make sure that we're identifying areas where we might be inefficient, where changes might be required, or we're identifying areas where we really need to get industry support to make changes. We need to, of course, review the actual outcomes regularly. So a costing process is, of course, a forecasting process. It's what actually happens that's important, and we need to come back to that all the time. Thirdly, we need to remember always to be costing to likely outputs, not capacity. So remembering things like the productivity of staff and their capacity, we always go back and look at history to make sure that what our assumptions and our expectations are aligned with what we've historically been able to do. If they're not aligned, we need to be able to explain to ourselves whether or not those things are, or those expectations are realistic, and whether we can move and undertake our activities within the NDIS price. That probably takes me to the final point, which is relating to reasonableness checks. Always coming back to seeing what's happened previously, always checking your comprehensive cost and expected price against the reasonableness of the NDIS prices, and making sure you feel comfortable with the outcomes that are highlighted. There can never be too many reasonableness checks in a costing and pricing process. That's it for this particular webinar. I hope you found it useful. Remember to go back, have a look at that Joint Costing and Pricing Project Final Report. Consider the percentages that are in that report against all of those cost items, and consider whether or not it's worthwhile you constructing your costing and pricing exercise to reflect those cost elements, so that you feel more comfortable about reconciling each individual cost element, what you cost to deliver services, what your target price is as compared to that provided by the NDIS. It's a very, very critical activity from a sustainability perspective. Thank you very much, and I look forward to talking to you next time on the Costing and Pricing Learning Program.